Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference. And I'm here with Bruno del Ama, CEO of Global X. Bruno, great seeing you.
Yeah, pleasure to be here.
You folks are one of the most innovative ETF companies. I mean, you pick your spots here domestically and around the world. You've always got some new and innovative strategies. What are you most excited about right now?
Listen, the new buzzword is smart beta. There's a ton of strategies coming to market in smart beta. I think some investors are excited about them, looking at them. Some investors are maybe tired of them. There's some things happening in smart beta, particularly the multi-factor investing, that are just fantastic for investors. In our view, they're going to bring a lot of active management assets into the ETF world. And they're really sort of a combination of some of the great things about passive investing, low cost, transparency, and some of the benefits of active management, bringing a lot of those systematic strategies like value, small cap together in a very thoughtful and useful way for investors.
You just launched a suite of four kind of scientific beta offerings. Tell us a little bit about it, because they're special in a certain way.
Yeah, they're very unique. I mean, we are thrilled to be partnering with the ETF Risk Institute, which is the premier risk institute when looking at investing and factor investing. And we've partnered with what we think is the best in-class institution. Their lineup of scientific beta ETFs, we have 4 ETFs that cover the world and really provide institutional grade products at a low cost to our investors that can really fit into their core allocation.
Explain scientific beta.
Yeah, scientific beta, what they do is they look at the factors that we know work. So when you invest in certain things like value or a small cap over, say, 15 years, you're likely to do better than market cap weighted. There's 4 factors that are proven by academics to work, those 2 as well as momentum and low volatility. Any one of those factors over a 5-year period, for example, value over the last 5 years has been underperforming very significantly. So you can buy something that's going to do better over the long term, but underperform short term. When you combine 4 things that work over the long term, but work at different times, you combine them on the right way, you're likely to not only outperform the market, but outperform it in a very consistent basis.
So within those 4 factors, you're not necessarily equally spread among the 4. The scientific aspect will actually weight which area might be the best to be in at that period of time?
That's correct, and that's something that's very interesting and what scientific beta and ETHEC called smart beta 2.0, which is how do you weight across those factors? And a lot of what people look at, which is diversification and really look at different exposures, the way they allocate across the 4 factors is a big component of their methodology and something that not only lowers volatility, but produces more consistent returns.
Great. Bruno, as always, great to see you and congratulations.
Thank you.